Okay, good morning, good afternoon, or good evening, depending on where you're zooming in from. And a very warm welcome to this NBS Knowledge Lab webinar series with the IMF today on the role of the private finance or financial sector in the transition to a green economy. I'm your moderator, I'm Yogesh Khatri. I'm an associate prof at NBS, as well as an academic director of the Nanyang Fellows MBA program, among other things. And I also spent more than a decade at the IMF, so this is a very IMF affair today. I spent also about a decade in the private sector. Now, today's topic is very much in line with NTU's focus on sustainability and follows from a recent webinar we did in August on green and sustainable finance, where we had panelists from MAS, JP Morgan, a fintech company, and my old colleagues from GIC. And the recording of that webinar is on our website, and I'd recommend you have a look at that. And this webinar will also be posted there eventually. So I think it's widely accepted that unmitigated climate change poses a massive risk to communities and economies everywhere, and that the transition to a sustainable economy, a green economy, is probably the largest global public policy challenge we face. And I say that, fully cognizant that we're in the midst of, or hopefully the tail end of, a global pandemic. And so there's been an awful lot of work on sustainability in recent years and a lot on the role of sustainable finance. Now, much of that work comes from regulators, central banks, the financial sector, and academia, including the webinar I mentioned earlier. But today's discussion provides a global public policy kind of top-down view on the role of private finance from one of the key international financial institutions. So it's an excellent complement to what we've done and what we've seen in the past. Now, in terms of the format for today, after I'll do a very brief introduction to the speakers, the three panelists will present for around 30 minutes in total, and then I'll moderate a Q&A for the remainder of the hour. Now, please, at the bottom of your screen, you should have a Q&A tab, so please submit any questions that you have at any point, actually, and I'll try and in real time curate and combine like questions to present to the panelists and during the Q&A session. So you have our speakers' CV, so I'm not going to go do a detailed introduction, but I'll do a very abridged introduction and what they're likely to cover. So our first speaker is Charlotte Gard, who's a financial sector expert in the Monetary and Capital Markets Department of the IMF, I believe. And she's covering there at the IMF climate risk, sustainable finance and the like. And she was previously at the French Treasury of the Ministry of Finance with a similar focus. Now, Charlotte will first do some scene setting, which includes kind of what exactly is a COP, and hopefully she'll help us demystify some of the alphabet soup that is related to climate change. Charlotte will also help us understand what came out of COP26 in Glasgow recently, including the main areas of progress and particularly the big gaps remaining. Now, then Felix and Yishi will run through the key takeaways from a recent IMF study. This is chapter 3 of the IMF's flagship Global Financial Stability Report, or GFSR. And that was on the role of investment funds in green transition. Very interesting paper we'll get. Felix is also a financial sector expert, and he's in the GFSR, Global Financial Stability Report division of the IMF, where he's been leading various studies relating to climate change, sustainable finance, and financial stability. Previously, he was with the UK's FCA, Financial Conduct Authority. And finally, Yishi is an economist also with the GFSR division and also having been a major contributor to IMF studies published in GFSR. And I think Yishi came straight to the IMF after completing his PhD at UCLA. So I should also mention somewhere with us today is Natalia Novikova, who's the IMF resident representative here and who made all of this happen. So thank you, Natalia. And she has a rich background in finance, and we may call on any Singapore-specific questions. So that's it. I'm going to pass it over to Charlotte, who will then hand over to Felix and Yishi directly, and then I'll come in after they're done with a Q&A session. Thank you. Over to you, Charlotte.
Thank you. Thank you very much, Khatri. Very nice to meet you all, and I'm going to do the nice stage setting on sustainable finance and climate change. I'm just waiting for the slides for you to have some visuals, which will make it easier for you to understand our whole speech today. So sustainable finance has become more than just a trend, actually. This is on my first slide. Sorry about that. Thank you. Yes, indeed, sustainable finance has become more than just a trend, and that's what you saw in the previous webinar that Katri just mentioned. So ESG tapped issuance actually has continued to register strong growth in 2021. Actually, global issuance of all sustainable debt has reached over $1 trillion in the 10 first months of 2021, which has exceeded 2022's record issuance already. And green bonds in there remain the largest debt instrument. That's what you can see on the slide here, while sustainability-linked debt has seen the fastest increase. And while developed markets have driven most of the rise in the issuance volumes throughout 2021, debt issuance by emerging market economies has also increased steadily, and most notably actually in the Asia-Pacific region. And diverse instruments such as sustainability-linked bonds and social bonds appear as complementary to green bonds in emerging markets economies, with a notable increase in 2021. The development of standards and labels for debt instruments in various regions, and especially in the Asia-Pacific region as well, aim to enable, in this context, more robust assessment, and they also aim to enhance investor confidence, and they encourage more investment with the European Union or other international fora, with the ASEAN region also leading the way on the policy front. So in this context, there has been a notable trend recently, which has been the COP26 Summit, which held in Glasgow in Scotland. COP26 has been a momentum for climate action. That's what you'll see on the next slide. What we mean by that is that two things came out of the COP26 Summit after very intense negotiations between all parties. The first thing is that there was a climate pact that has been agreed upon by all parties to the summit. And this Glasgow, so-called Glasgow Climate Pact, has been completing the Paris Agreement from 2015 and has constituted some progress, though actually some very crucial topics remain unsettled there. And so without repeating what you can see on this slide, what I can point out to you today is that first, it's the first time that there is a mention of fossil fuels in a COP agreement. And though there is not a mention of phasing out all fossil fuels and all coal power, most notably, there is at least the language of phasing down what we call unabated coal power. So coal power that does not have any recourse to carbon capture and storage technologies. That's a very good lesson from the COP26. But apart from the climate pact, the Glasgow Climate Pact, COP26 has been a momentum for climate action. And what we mean by that is that around the COP, some other pledges and commitments have been made by parties to the COP, but also by the financial sector. And because the Glasgow Climate Pact, like the Paris Agreement, actually point out the very important role of the financial sector in trying to align capital flows on a low carbon trajectory, we can see that many commitments are very complementary to that extremely important role of the financial sector. By that, I would like to point out maybe the establishment of the International Sustainability Standards Board, which has been announced by the IFRS Foundation, which will lead to enhance the quality, the transparency, the reliability of climate and of ESG-related disclosure by corporates and by financial institutions alike. And I'd also like to point out voluntary commitments by financial market participants, such as the Glasgow Financial Alliance to Net Zero, that has been bringing together net zero finance initiatives in one sector-wide coalitions. But key methodological concerns remain there. And so that's something we'll have to watch out for the next months. So though COP26 has spurred this momentum for climate actions, some very important topics remain unsettled. And that's what I tried to describe in the next slide. So basically, it's very important to note that adaptation finance has been lagging. That's actually a big topic, especially for developing economies, obviously. There is also what we call an ambition gap. So if you look at the greenhouse gas emissions reduction that will come out from the COP26 agreement, compared to what the Paris Agreement tells us to do, which is not to overshoot that 2 degrees increase in temperature, in global atmosphere temperature, then we have a gap in temperature there. And this gap is still 2.7 degrees increase in global temperature. So there is still way to go. Adaptation finance is lagging, as I also said, it's very important to bear in mind that financial sector action is obviously super important. It's in the Glasgow Climate Pact, but it still lacks some mandatory targets. It still lacks some mandatory methodologies to be applied by these coalitions. And that's why regulation policy is actually very important in this regard. It's also very important because there is no accountability mechanism in the Glasgow Climate Pact, nor in the Paris Agreement. So in order to decrease that ambition gap that you can see on the graph here, it's very important to rely on regulatory policy for that matter. I'd like to make a quick focus on one key issue of the COP26 that has been the fact that there is no phasing out of all coal power. And that's what you'll see on the next slide, because this fossil fuel issue is also obviously a very strong market-related issue. So in this regard, maybe take a step back. In the COP26, there have been several campaigns. That's what the UK presidency has called campaigns. What I mean by that is that there have been several goals to be tackled by the COP26. And one of them was the finance campaign. And the coal issue is part of this finance campaign. What we mean by that, and given the importance of regulatory policy for the financial sector, is that we must act on several fronts. One of them is the disclosures front, and I've talked about the ISSB creation during the COP. One other topic is the enhancement of risk management practices. Another one also is the fact that the financial sector and all capital flows have to align on a net zero goal. And the last topic, very important one that I tried to describe much earlier with the rise in global debt issuance, for instance, is the mobilization of capital. So the coal topic stands actually at the crossroads of all of these very important objectives of the finance campaign of the COP26. And so that's what you'll see on the next slide. Why am I doing that focus on coal? Because it's the most emissive energy, obviously. And because there has been in the COP26 agreement an unprecedented commitment for coal phasing down. And so if we go to the next slide, you'll see that there have been some trends on the marketplace related to coal already. And COP26, because it has constituted that momentum for climate action, has been one great deal actually of action on financial markets related to coal. I don't know if we can go to the next slide so I can present the graphs there. Because at the IMF, we do what we call an environmental, social, and governance monitor. We monitor financial markets from an ESG perspective, and these are graphs that are taken out from one of the most recently published ESG monitors that we published a few days ago. So what you can see on the left-hand side, for instance, is that amid mounting ESG pressures and with the Glasgow Climate Pact actually urging parties to accelerate the phasing out of coal power to limit global warming to 1.5 degrees Celsius, not to overshoot that 2 degrees Celsius objective, coal mining companies have experienced a much more challenging road forward throughout 2020 and throughout 2021. And you can see on the right-hand side of that graph, the depreciation of their stocks performance leading to COP26 and after COP26. Another topic related to coal is the rise of methane emissions, because coal mining especially leads to a rise in methane emissions. And because global methane emissions have risen nearly 10% in the oil and gas and the coal mining sector, that's why there is in the Glasgow Climate Pact to mention that we must substantially reduce methane-related emissions in the Pact worldwide. And especially in Asia, as you might see on this graph, that there has been a very steady rise of methane emissions in this region due to the expansion of the coal mining sector. And so I'll finish with this overview with my last slide on the evolutions of financing to the thermal coal sector, especially in Asia, because that's where the progress still needs to be made, obviously. And that's related to the just transition issue that has been one of the most talked about issues during the COP26. On the left-hand side of the slide, you can see that the evolutions of loans to thermal coal corporates has shown a very substantial decline since the Paris Agreement, especially the volume of bank loans that have been granted to Asian coal companies. It has decreased by about 40% between 2015 and 2021. And the overall number of deals as of November 2021, which is the date of the COP26, has almost returned to 2010 levels. And top parties for the vast majority of these deals are Chinese and Indian credit institutions. So this is something very important to note, especially because 10 countries with the largest coal power pipelines worldwide are all located in Asia, bar South Africa. And finally, you can see on the right-hand side of this slide, the fact that the substantial increase of the bond market for Asian coal companies has shown that it's actually a highly leveraged sector in the context of a steady development of the coal sector across the region, because coal companies have benefited from way more favorable financial conditions recently, and debt issuance has reached that record high. The coal industry's debt market has grown by over 263% actually in the past 2 decades, and Chinese and Japanese banks are the top parties to these deals across the whole period. So we see that looking forward, the Asian banking system exposure to coal assets may cause some financial challenges given the ambition transition that has been set forth in the Glasgow Climate Pact, as I told you about. And that's why coal has been called as a stranded asset, actually. And that points out to the risk management issue of that finance campaign of the COP26. So I stop here to let my colleagues describe the GFSR chapter, but I hope you got a good overview of what climate entails for financial regulation at a global level, and what are the outcomes of the COP26, and still the very long way forward to go. And I look forward to the Q&A session. Thank you.
Thank you, Charlotte, and thanks again for giving us the opportunity here to present the chapter 3 of the Global Financial Stability Report, which is called Investment Funds Fostering the Transition to a Green Economy. To give you maybe a little bit of background, this is actually the 4th chapter of the Global Financial Stability Report that deals with climate or sustainable finance. We started in October 2019, where we gave an overview of sustainable finance markets. In March 2020, we looked at climate change, physical risk, and equity prices. In October of last year, we had a chapter on the environmental performance of firms during the pandemic. And now this chapter is our latest effort, and it focuses on the role of investment funds in fostering the transition. So I'll go over a few slides of summary and motivation, and then pass the floor to my colleague, EC, who will discuss the main findings of the chapter. So as you can see on this slide here, the transition to, I think the point is the transition to a net zero economy is essential, right? And there is a strong policy momentum, as Charlotte has just pointed out. And we think that the financial sector has a key role to play in this transition by pricing in the transition, which is crucial from a capital allocation perspective, and also through a stewardship, which can help the corporate sector move to a more climate-friendly business model. But of course, there are also financial stability issues, right? The sector has a sizable exposure to firms that are sensitive to the transition. So there are potential financial stability implications, which we touch upon in the chapter, but we'll sort of skip over that during the presentation today. Next slide, please. So here you see a brief conceptual overview that should illustrate how sustainable investment funds can speed up the transition. So on the left, we have the investors, and they make portfolio decisions based on 2 sets of factors, right? First, their assessments of risks and opportunities, and second, their preferences for sustainability. And these decisions then, based on these 2 factors, they create flows into funds, into both conventional funds and sustainable funds. And just to be clear on the language here and what we mean by sustainable fund, when we say sustainable funds, we mean funds that differ from conventional funds by having a sustainability objective on top of or in addition to an objective to obtain or generate financial returns. So these are funds that have a dual objective, right? These flows then can affect the corporate sector through two channels, and that's what you see on the right-hand side of this chart here. First, through proxy voting. So this is a stewardship channel. So through proxy voting and engagement, funds can influence directly firms and push for a transition, transition-aligned corporate policies. That's one channel. And the second one is a cost of capital or a financing channel, right? So by funds flowing into these sustainable funds, that pushes up the relative price of securities that are issued by relatively green firms, and that makes it easier for such firms to raise capital and to finance their project. Then taken together, these two mechanisms, they can drive firms' transition to a more climate sustainable business model. Next slide, please. What I do now is I'll give you a brief overview of our sample and explain also this sample should roughly capture a big chunk of the market. So it's a sample overview, but also it's a market. So in the chart on the left, you see a snapshot of our sample by end 2020. We cover mostly open-ended investment funds that are sourced from Morningstar. These are mostly fixed income, equity allocation funds. Most of the funds are domiciled in advanced economies, but it's a global sample. And we label these funds based on labels that are provided by Morningstar, Bloomberg, and Lipper, and also by considering the name of the funds. These labels are then based mostly on information provided by the fund themselves. So these are basically how the funds describe themselves. And what we see here is that by end 2020, we have 36,500 funds in the overall sample. Of those, 4,000 funds are ESG or sustainable funds. So those with an ESG label or a sustainability label. Of those, then about 1,000 identify as having an environmental focus, and of those 1,000, just over 200 have a climate focus. So the overall size of the sustainable fund market, and that's what you see in the middle panel, and the overall size of the climate focused funds in particular is really tiny compared to the overall market. Total AUM of total assets under management of the funds in our sample is 48 trillion at the end of the sample period in the fourth quarter of 2020. Sustainable funds are about 3 trillion. Climate labeled funds have 130 billion in assets under management. So that's 0.3% of the total sector. However, the sector is growing rapidly. That's what we have on the chart on the right here. Sustainable funds, environmental funds, climate funds, they've all grown much faster than their conventional peers in the recent past. Next slide, please. We then look beyond the label at the portfolio composition of the fund. So measuring funds investment focus is in general tricky. What we do is we focus on two variables, the carbon intensity and the transition opportunities of the underlying assets of the funds. Transition opportunities, it's a score, it's a composite measure based on a range of metrics. For example, companies' carbon reduction efforts or the development of products or technologies that are related to renewable energy. That's one measure, the transition opportunity score. The other one is carbon intensity, and that describes a firm's greenhouse gas emissions relative to revenues. And what you can see here is that for advanced economies, both metrics have remained relatively flat. So there hasn't been much progress by firms in the past, say, 10 years in terms of cutting emissions, for example. For emerging markets, we see that both metrics have been decreasing, so improving. Sample issues are a bit of an issue here because the sample is relatively small at the beginning of the time period and then increases. So we need to take these results with a grain of salt. Next slide, please. What we then do is we compare the portfolios of climate funds and of conventional funds. What we see is that those funds with a climate focus, they hold a different set of securities. They hold more securities with high levels of transition opportunities measured by this score that I just described. And that is, I mean, of course, in line with funds actually investing in firms that support the transition. What we also find, which is a bit surprising, is in that you can see that in the chart in the middle, we see that the carbon intensity of climate funds are actually higher than the carbon intensities of conventional funds. That's, for example, consistent with a story where climate funds hold relatively high carbon intensive firms, but are then working on reducing emission, right? It's also consistent with investments in firms that contribute to the transition, because we are here capturing scope 1 and scope 2 emissions. So these are not the emissions, the downstream emissions, scope 3 emissions. And in the chart on the very right, you see when here we look at the industry composition of funds, and we see that climate funds have a substantially larger exposure to firms in transition-sensitive sectors compared to conventional funds. And again, this is consistent with these funds having a focus that is more in line with furthering the transition. So the key takeaway here from the last few slides is basically climate funds do indeed invest in the transition, but they are small compared to the overall sector, and aggregate emissions have really not moved much. And this, I guess, is a call for that more needs to be done. And let me hand it over to Yisi.
Thanks a lot, Felix. So in the next few slides, I'll briefly discuss what drives the flows into the sustainable investment funds and what the implications are on the corporate sector's climate stewardship and security issuance. So in this slide, we ask what aspects of the investment fund sustainability are relevant for the fund's inflows. And this is an important question if we want to assess the policy options for scaling up the sustainable finance. And in particular, we compare the effects of the fund's labels on the inflows to the effects of the constructed fund scores based on their underlying portfolio. So the chart on the left side shows that a fund with a sustainability label receives around 1 percentage point higher inflows than the conventional fund in our sample. And the impact is even stronger if the investment funds have the environmental or the climate labels. And note that this effect is after controlling for the sustainability scores of the underlying portfolio, which also allows us to see the impact of the sustainability scores on the flows. And as you can see from the last 3 bars on the left chart, the impact of the sustainability scores are actually much weaker. So overall, it's evident that the labels do matter to attract the investment funds inflows, and their relevance has increased over time. As we can see on the right-hand side chart, the red line is in the second chart indicates the sensitivity of the fund's inflows to the sustainability labels, which has been significantly increased in the past 5 years. And in contrast, the sensitivities of the fund's flows to the underlying portfolio's carbon intensity or the transition opportunity scores have been much weaker historically. To summarize this slide, so investors appear to pay more attention to the investment fund's sustainability labels, but not necessarily to the portfolio holdings, which underscores the potential of the widely accepted classification system for the funds that are associated with the sustainability labels. And it also underlines the importance of making sure whether this classification system captures the meaningful information on the sustainability to avoid the greenwashing. So moving to the next slide. Next slide, please. Yeah, so we'll now focus on the 2 channels through which the funds can influence the corporate behavior. So in the first channel, is about the stewardship or the investor's activism. We test whether the funds with the sustainability labels or higher sustainability scores are more likely to engage with the management to push for the climate-friendly policies. And looking at this chart on the left, what we show here is the likelihood that the environment, sustainability, or other conventional funds will vote in favor of the climate-related issues. And it is encouraging that there is a general trend that all the investment funds are facilitating the green transition, reflecting the trend that towards the ESG integration in the sector. That being said, it is obvious as well that those investment funds with the environmental or the sustainability objectives are more likely to vote in favor of the climate-related proposals, as we can see from this blue line and the red line. And we then test this relationship more formally using the econometric model, and we find indeed that the funds with sustainability or the environmental labels are more likely to vote in favor of the climate-related resolutions. As the second chart shows, on average, the sustainability funds, excluding those focused on the environment or the climate, are 10% more likely to vote in favor of the climate-related proposals relative to their conventional counterparts. And the environment or the climate funds are even 30% more likely to vote in favor of the climate-related proposals. And on the other hand, the portfolio scores do not seem to be associated with how a fund votes or even have the opposite effect of what we might expect, which is shown by the next three bars in the second chart. And moving to the next slide, please. We have also shown that the investment funds' net inflows are related to their sustainability labels. Next, we test whether the flow into sustainable funds impact the firm's decision to issue the securities. And in the first two charts, we show that how strong the relationship is between buying pressure from the sustainable funds and the security issuance of their related green funds. And here we define those green funds, the greenness of the companies by the four different indicators: the ESG score of the firm, the environmental or the E score of the firms, and the transition opportunity score, which captures the potential for the transition, and also finally the carbon intensity of the company. And we find that when a green firm, especially those with a higher ESG score or higher E score, are more exposed to the buying pressure from the sustainable funds, and then those green firms are more likely to issue the bonds than the companies that are not green. And on top of that, we also see that those green firms issue larger volumes of both bonds and securities. And as you may have noticed, the mechanism is much stronger if we define the greenness of those companies based on the general ESG scores or the environmental scores. And it's weaker if we define the greenness on based on the narrower climate-related measurements, such as the transition opportunity score or the carbon intensity. So in the last chart, we analyze if the flows to the sustainable funds are also related to the green firms' asset prices. And we studied the relation between the price pressure triggered by the high net flow sustainable funds and the returns of their related green securities. And in line with the mechanism that has been shown in the previous charts, the high sustainable funds price pressure is associated with the higher abnormal stock returns for the issuers with a higher ESG score or higher E score. So to conclude this slide, we find that the flows into the sustainable funds can help the companies to adopt a more climate-friendly business model through the stewardship or by encouraging the issuance of the securities. But additional policies are needed to support the flows into sustainable funds and to scale up these mechanisms. And this leads us to the final slide, which is about the policy recommendations in the chapter. So first, the first policy recommendation is that the policymakers need to urgently strengthen the global climate information architecture, which covers the data, the disclosure, the sustainable finance classifications, both for the companies and also the investment funds, in order to facilitate the pricing of the risks and opportunities. And to give some idea about the urgency of this issue, our IMF team has done a survey among the asset managers on the most important obstacles those asset managers are facing in sustainable financing. The most pressing issue that has been identified in the survey is a lack of the current data and the forward-looking data. So even in these efficient markets of the investment funds, data transparency on the climate-related information is still lacking. And the second policy recommendation is that the financial regulators should ensure the appropriate regulatory oversight to prevent the greenwashing and also to foster the sustainable and climate finance markets. And this also helps to mitigate the potential financial stability risks that may arise if a large transition shocks hits the market. And once those elements are in place, and then one could consider additional tools to help channel the savings into the sustainable funds. For instance, the financial incentives for the investments in the climate-related investment funds. And it's also important to note that those tools should be considered as the complements rather than the substitute to other climate change mitigation measures, such as carbon tax. So with that, I will I will stop here and then pass it back to Yogesh.
Oh, wonderful. Thank you to all of our speakers. And I should have mentioned up front that it's 9:30 in Washington for the two of you, and for Charlotte, it's 3:30 a.m. So a huge thank you for being so awake and coherent at these respective times. So we've got some really interesting questions coming in. So I was going to use my moderator's privilege to pitch a few questions, but I want to go straight to one of the questions from the audience. So the person says, based on the presentations of the second speakers, it appears as if sustainable finance focuses on relatively small projects in high carbon intensive sectors, and hence sustainable finance may not really be making an impact. So does it mean that green finance is really kind of about funds using it to greenwash? So that's the question. I think I'll kind of put it in a more general context as well. I guess it kind of gels with one of my questions, which is to what extent do we find evidence of greenwashing, and what do we look at, and how do we address it? So I'll give all of those to maybe Felix and Yishi.
Yeah, happy to jump in here. So first, maybe I wasn't clear enough in the presentation. We try to differentiate between a climate themed fund and a sustainable fund, right? Or a fund with an ESG focus. And what we find is that the climate themed funds, they really do have portfolios that look different from an ESG type fund. So they invest in different types of assets. They invest in these assets which are high on transition opportunities. So high on, these are investments in firms that try to develop product and work on products that further the transition, right? So that's some evidence we find. And then the other piece that I think is slightly confusing when you look at it firsthand is first sight is that the carbon emissions of these firms, the scope 1 and scope 2 carbon emissions, are actually slightly higher than that of conventional funds. It's not a major difference, but they're slightly higher. And the way we interpret that is that these funds are investing in firms that either reduce their emissions or need to reduce their emissions, that could go through the stewardship channel. And there we see a lot of evidence that climate-themed funds really vote in favor of climate-related resolutions, right? Or that could point toward investment in firms that build products which themselves are not low emissions, but which can generate low emissions. Right? Think about the Teslas of the world. So that would be my answer. So from what we see in the chapter, there is no clear evidence of greenwashing. But measuring greenwashing is of course super tricky. And let me stop here. We see that the sector is small. It's not particularly effective yet in reducing emissions, in making a change. But that small sector that we look at, that seems to be active in the right direction.
Wonderful, Felix. Thank you. I'm trying to curate and put together questions that are similar. So there's another question on, I guess, Charlotte, maybe I'll ask you to take this, which is, you mentioned one of the challenges is data and reporting and taxonomies, etc. So everyone I speak to in finance has the same set of challenges. The question is, will the ISSB be will that make a big difference? Will it be a key enforcement agency against greenwashing? How much power will they have? What kind of difference will they make?
Of course, thank you, Katri. I'll answer that shortly because I think this is a very wide topic, but let's say that disclosure is actually a key topic as soon as you want to develop sustainable finance. It's a prerequisite. It's not an end in itself, an end goal, but it's a prerequisite. And because there is not the same level of comparability of data for extra financial data as there is for financial data, it's become crucial globally to land with such a global institution. So that's why the International Sustainability Standards Board has been created. It actually stems from very wide developments in the European Union initially, and there's been a strong push to have that common level of reporting that could be set up at the international level, especially on climate change amongst all ESG topics. So the goal is really to try to, for extra financial information, to reach the same status as financial information. And that means to have common standards, that means to have common rules for auditing, and that's what the ISSB will put forward. The IMF will be a member of its consultative committee, actually. In terms of power and enforcement, it's a subset of the IFRS Foundation. So it doesn't have any enforcement power per se, but it has the very strong power of putting forward the rule and the norm, which is the basis of any financial regulation. So that's why it's been seen as a major advance these past few weeks, and we, of course, expect a lot from it.
Just to kind of tag on, Charlotte, given your Europe background, there's a question that asks whether the EU taxonomy would address the challenges of a lack of taxonomy in defining sustainable activities.
Oh, wow, that's an even wider question. I could talk hours about the EU taxonomy in my previous position. I think I probably did 100 conferences on that, so happy to discuss later on. But let's say that the EU taxonomy, as any other taxonomy actually that has been developed in Asia as well, the ASEAN has put forward the taxonomy, Malaysia has been putting forward the taxonomy, Japan is thinking about it as well, has been developing one. Let's say one of the great advantages of taxonomies is both to set out a roadmap for sustainable investing, and if it's sectoral holistic, it's even better because it has to cover the transition in all sectors of the economy. And so its role is to provide that roadmap, but also to prevent greenwashing, because if everyone's got the same criteria, if I might say it this way, to actually evaluate a sustainable investment, so the best it is to actually enhance investor protection in this regard. So the EU taxonomy has got this, these objectives as other taxonomies that have been put forward. And some work has been done at global level as well to develop common criteria for sustainable finance taxonomies and classifications also for other types of products. So that's something that the person, asked the question if he or she is interested to look at the work of the G20 and the international platform for sustainable finance also that has been comparing the EU and the Chinese taxonomy.
Wonderful. So look, I'm going to combine a couple of questions for maybe Yishi, maybe I can pitch this to you. One is, do sustainable funds really outperform conventional counterparts? And linked to that, there's a question of for green financing to, where are we, sorry. For green financing to be an effective tool for climate, to drive climate action, it has to offer corporates lower rates and lower costs of funding, but then at the same time, banks and capital markets need to be profitable. So where and how are they going to get cheaper sources of funds, and how can they lend cheaper rates to financing? So two kind of somewhat related questions there.
Yeah, sure. Thank you for the question. So I think for the first question, in our chapter, we didn't directly answer that question. Excuse me. We didn't directly answer that question whether the sustainable funds underperform or outperform the conventional counterparts. But maybe I can give some thoughts here. So I guess for the sustainable funds, they're holding the green assets. And those green assets are, for the investors, maybe they have more preference to hold those green assets. And those green assets are the good hedge for the potential climate-related risks. So because of those preference to hold those green assets, and they're the good hedge for the risk, for potential transition risk. So the risk premium that is associated with those green assets might be smaller. So that's why we thought that it's potentially that in the equilibrium, when there's no shock that hits the market, and then the sustainable funds may have some lower returns than the conventional counterparts. But that being said, I think whenever there's some shocks related to the transition risk, and then I think there should be some structural shift in the investor's preference. And then the investor might have increased the taste or increased the preference to buy more of these kind of investment funds. And this will potentially push up the return of those green assets, which also make the sustainable investment funds to outperform the conventional counterparts. So I think the story of this is really depending on whether we're talking about the equilibrium of the markets, or whenever we're talking about there's some additional transition risk shock that hits the market. So that's the answer to the first question. But for the second question, which is also not directly answered by the chapter, because that's about the banking sector, but we do have some research going on, which is between me and Felix. We actually have some research topics that's about the banking sector, how the banking sector is playing a role for the green finance. And what we found actually in at least the advanced economies is that the banks, or the large banks in the advanced markets, they have developed into two different kinds of banks. The one that it has a higher exposure to the securitization markets, they tend to lend more to the brown funds, but the banks with less exposure to securitization markets, they tend to lend more to the green funds. And this is because the banks with exposure to securitization markets, they can actually issue the loans to the brown funds and then securitize and sell them to the securitization markets, which their counterparts are the asset managers or the CLO. So probably we think that this is possible, that those players in the securitization markets have higher preference for those brown assets. So they kind of like lower down the funding costs for the different kinds of assets, which also helps the banks to issue, to release more funding and then issue the loans to the green funds. So I guess maybe this is like a complement of the two different players in the financial markets. So it's not only about the banks, but also about the CLO and asset managers in the markets. I hope that answered the question. Yeah.
Thanks. I guess possibly related, and whoever would like to take this, we had a recent event with we have an industry group called FAME, Forum for Asset Management Ecosystem, and a colleague on that really raised two interesting questions, or two interesting points. One is, are we potentially in a bubble in green assets or in green finance, to the extent that everyone's on the same side of the bet or the trade, and without any recourse to valuations, and everyone thinks it's a great thing. So it sounds like, elements of a bubble. It might be a good thing, but the question is, sometimes bubbles burst and can create a mess. So that's kind of, is green finance a bubble? And the other question is, should funds, do funds actually make sustainable investment funds make a difference, in the sense of, if they're trading secondary market assets, then for every seller, there's a buyer. So things like exclusion or divestment from, brown economy, there's someone on the other side of the trade and buying it. So does it actually have a net impact on carbon or greenhouse gases or sustainability? So two questions for whoever I think would like to take that. Maybe Felix?
Sure, happy. I can get started, and maybe C can jump in. So on do these exclusionary criteria, for example, do they make an impact? Do they matter? Clearly, for every buyer there is a seller. For every seller there is a buyer. But I think what the literature has shown, and what we show also in the chapter to some extent, is that there is a price impact, right? So there's a literature, for example, on sin stocks, which used to be tobacco, weapons, and so on. Nowadays, maybe it's also coal. I don't know. And what people find there is that if you hold these stocks, you require a higher rate of return. So that makes the funding for these firms more costly, and thus reduces their ability to finance projects. So there is a bit of an impact there, and we find the same thing on the upside, basically on the positive, right? So what GC has shown is that if there are flows into these funds and there is more buying pressure instead of selling pressure, then we see the cost of capital go down, which is the equivalent of the returns are going down, right? You could call this a bubble. It could also be a persistent change in investor preferences, right? In which it becomes a philosophical question more. If you want to call this a bubble, is a bubble when it bursts, right? If preferences change in equilibrium over the long run, that means there is a change in prices. We do a bit of a reversal. We see a bit of a reversal when we look at the price impact. So that could point to some liquidity-driven price effects there. Again, you could call this a bubble. You could call it a liquidity-driven price impact.
Yeah. What is a bubble, I guess? Charlotte, maybe I can pitch a question to you. But we've talked a lot about public markets and disclosures and data and taxonomies. We have a question about whether private equity firms can better equip private markets for better ESG disclosures. And I'm going to tack on to the end of that. Are there potentially any unintended consequences of this reporting requirements, to the extent that we've already seen less and less firms going to IPO and some going private again? And could these necessary but somewhat challenging reporting requirements push more firms to stay private? And which really emphasizes the importance of this question. And if we're just focused on public sector firms, that's one thing. But if the private firms and private equity is an increasingly important segment of finance, what do we do there in terms of better equipping them for ESG disclosure?
Yes, thank you, Katri. I think it actually raises several questions. The first one, and I'm going to speak more from my EU-related background, but actually, for instance, in disclosure in the EU has not been solely about public companies. Private companies also have to disclose against ESG standards in a lot of member states right now, including in France, but not only. And they will have to, according to the new regulatory framework that will emerge as per next year, actually. So research there has shown that at the end of the day, the issue is to have enhanced ESG disclosures, including for these firms, and also because most of the time, public companies will actually rely on their subsidiaries and on their whole value chain to come up with better ESG reporting. So that will have an impact also on private firms and also on smaller firms. I know that's a different issue, but sometimes the two are related. If it's got an impact on IPOs, again, I know just about the EU in this context, but research has shown that the relative decrease in IPOs in the EU has not been due to these enhanced reporting requirements, but to other factors that are more like macroeconomic related. I think it all depends on the level of standardization that you ask at the end of the day, because of course you also have to make sure that any standard that is out there is matching the particularities, the specificities of the sector, of the size of the company, of its public or private nature. And research has shown that the most, how can I put that? Like the most specific it is to the company, the best it is to actually enhance its market value. And so that does not have so much of a negative impact at all on going public. So I think all of these issues are really interestingly related. but at least research in the EU has shown that it's not a negative trend per se. But maybe my colleagues have other comments more like at a global level. Again, I've got more initially of an EU background, so that's why I tend to answer on this front, especially because mandatory disclosures have been solely in the EU so far. So that's why we have research in this particular area of the world also.
Yeah, no, that the European perspective is really valuable in this space, given that kind of the avant-garde element of kind of climate policy. We're literally, I've got a huge number of questions that are here, but we're kind of running out of time. So I'm going to ask a very succinct answer to the last question that came in. For an MBA student or an aspiring MBA student, is it worth considering focusing on sustainable finance? Are the long-term career opportunities there, or is this the flavor of the month? Now, just kind of very briefly, each of you, Yishi, as closest to having recently graduated.
Yeah, sure. So I think this is really a promising field. At least a lot of policy institutions, the central banks, and also the private sector, but also including academia are working on this field, the climate finance, and also anything about the climate change, the policy related issues. And also at the IMF, we're also hiring a lot of experts on this field, either the interns or the economists or financial sector experts. So I think this is really a promising field. And then if you have this kind of a plan to work on this, and then I think it's a really good idea. And then don't forget to apply for the jobs in IMF after you graduate.
Thank you, Felix. Sorry, Felix and Charlotte, any footnotes?
That's a tricky question. I'm a bit reluctant to give career advice. I would say do what you're interested in and what you're passionate about, and don't try to time the market. That would be my advice. But it's clearly an interesting field. There's a lot going on. There's a lot of work to be done. So if these two things match your interest and this potential ability to time the market, then go for it.
Excellent and very balanced IMF reply. Wonderful. Charlotte, you're a career sustainability person, so your thoughts?
Yeah, I'm biased also because I've most of my career spent on this topic, and also because I'm finalizing a PhD on this topic, so I'm biased. But I would say that according to what I said at the very beginning, unfortunately, because of climate change, it will always be a topic, and it's not so much the sustainable finance niche for now, but the need to finance the transition anyways, and to manage these stranded assets risks. That's why I always talk about fossil fuels to my colleagues probably every day. So I think that in this regard, it's not like a flavor of the month, and it's unfortunately, in a way, I would say, because of climate change, it will be a long-term trend. So I would totally advise you actually to go there. And, at least in the fields that I know in the EU or in the US, most firms now are recruiting not only financial analysts, but extra financial analysts as well, because it's all related at the end of the day. Climate is not so much an extra financial topic anymore, but it's becoming increasingly financial. So I would totally, give career advice in this regard. So I'm a little bit less balanced than Felix, but again, I just said at the very beginning, I'm biased, so you should take that into consideration.
Thanks, Charlotte. And I would say that gives me a perfect opportunity to pitch our new sustainability-focused MBA program, which you can find on our website. Look, we're literally at 11 o'clock. So there are some really good questions in the chat. Now, I would welcome the panelists to stay on for a couple of minutes and answer some of those in the chat if you have the time to do so. But now I want to just kind of wrap up. And so I want to start with, thanking you, with the panelists, thanking the audience for the great participation and great questions. I think I'll also just remind everyone that this is part of our NBS Knowledge Lab series, which we hold every month, typically on the last Thursday of the month, but we have pulled it forward because we're in the holiday period. And thanks to the comms team who run these series, including this one. I'd urge you to look out for the next Knowledge Lab webinar, which is on January on infectious diseases. Last words, stay connected with us via social media. Please take a minute to fill out the social media, the survey at the end of this webinar. And once again, thanks to the fantastic panelists. Thanks to you all for joining, and happy holidays.